Gold and silver have once again reached record price levels, drawing intense attention across global financial markets. These new highs are not isolated movements, but part of a broader and increasingly complex shift within the precious metals sector. Gold has surged to levels never previously recorded, while silver has followed closely, approaching price thresholds that until recently appeared distant. Alongside them, platinum and palladium have also registered notable gains, reinforcing the sense that this is not a single asset phenomenon. At first glance, such price behavior often leads to a familiar conclusion, that the US dollar is collapsing or rapidly losing its function as the world's dominant currency. This assumption has resurfaced as gold prices climb toward levels previously considered extreme and as silver trades near historically elevated territory. However, this interpretation fails to capture the full picture. The current surge in precious metals is not driven by a sudden breakdown of the dollar or by a uniform loss of confidence in fiat currencies across the board. Instead, the price action reflects a convergence of structural, geopolitical, and market-specific forces. These forces operate simultaneously across different regions and institutions, reshaping how gold and silver are valued, traded, and held. Understanding these dynamics requires moving beyond simplified explanations and examining the underlying conditions, influencing both investor behavior and official monetary policy. The rise in gold and silver prices is therefore not a single story, but a layered one. It involves shifts between Eastern and Western markets, policy signals from governments, physical supply constraints, and strategic decisions by central banks. Each of these elements contributes to the current environment in which precious metals are not merely rising, but redefining their role within the global financial system. A critical clarification must be made at the outset. The current surge in gold and silver prices is not the result of an imminent collapse of the US dollar. While the dollar has experienced periods of weakness and has lost value over time, the available indicators do not support the narrative of a systemic breakdown. On the contrary, the dollar continues to exert substantial influence across global financial markets. During the previous year, the dollar underwent a significant decline, reflecting broader economic pressures and policy challenges. However, this decline did not translate into a loss of its central role in global trade, reserves, or financial transactions. Entering early 2026, the dollar has shown signs of stabilization and even modest recovery. This rebound underscores the continued confidence placed in it by governments, institutions, and markets worldwide. The distinction is important because precious metals often rally sharply during periods of acute currency distress. In this case, the rise in gold and silver is occurring without such a collapse. The dollar remains the world's primary reserve currency, and no immediate replacement has emerged with comparable scale or acceptance. Its share of global reserves has declined over time, but it still dominates by a wide margin. Current market signals do not point toward an abrupt or disorderly unraveling of the dollar system. Instead, they reflect a more nuanced environment in which the dollar's long-term credibility is being reassessed, even as its short-term functionality remains intact. The strength of gold and silver, therefore, must be understood independently of a dollar collapse narrative. This separation between precious metals performance and dollar stability is central to understanding the present moment. It directs attention away from simplistic explanations and toward the specific mechanisms now influencing supply, demand, and institutional behavior in global metals markets. One of the most significant forces behind the rise in gold and silver prices is the growing disconnect between Eastern and Western markets. This divergence has altered how precious metals are priced, sourced, and distributed, creating structural imbalances that are increasingly visible in global trading activity. In Eastern markets, particularly in Asia, physical demand for gold and silver remains strong and highly responsive to supply conditions. These markets place a pronounced emphasis on the availability of physical metal rather than purely financial exposure. As a result, pricing dynamics in the East are more directly influenced by inventory levels, delivery constraints, and exchange-specific rules. This stands in contrast to Western markets, where paper contracts and financial instruments play a larger role in determining price movements. The separation between these two market structures has widened. As physical metal flows increasingly favor Eastern exchanges, Western markets face tightening conditions. This imbalance contributes to upward pressure on prices, as arbitrage between regions becomes more difficult and less efficient. When metal is less freely available to move across borders or between exchanges, price discovery becomes fragmented. This disconnect also affects how shocks are absorbed. Changes in policy, regulation, or supply can have immediate and localized impacts rather than being evenly distributed across the global market. The result is a pricing environment in which gold and silver can rise sharply without a single universal catalyst. The growing divide between East and West is therefore not a secondary factor, but a core structural shift. It reshapes how precious metals respond to demand and reinforces price strength even in the absence of broader financial turmoil. Geopolitical developments have played a direct role in reinforcing demand for gold and silver, particularly through renewed trade tensions. Recent threats by the President of the United States to impose additional tariffs on certain European countries arising from a dispute linked to Greenland have introduced fresh uncertainty into an already fragile global environment. These signals have been closely monitored by investors and institutions alike. Tariff threats carry implications that extend beyond trade flows. They raise concerns about retaliatory measures, disruptions to established supply chains, and the stability of diplomatic relationships. Even when such measures are not immediately enacted, the uncertainty they generate can influence asset allocation decisions. In this context, gold and silver have once again been treated as defensive assets, benefiting from heightened risk aversion. The response to these developments has not been limited to speculative trading. Instead, it reflects a broader shift toward assets perceived as politically neutral and insulated from policy-driven volatility. Precious metals, by their nature, do not depend on the fiscal or trade decisions of any single government. This characteristic becomes particularly relevant during periods of escalating political friction. As trade disputes reemerge and policy signals become less predictable, investors tend to reassess exposure to assets tied directly to national economies. The tariff threats connected to Europe have therefore contributed to renewed inflows into gold and silver, reinforcing their upward price momentum. These geopolitical pressures do not operate in isolation, but interact with existing market constraints and structural shifts. Together, they amplify demand at moments when supply flexibility is already limited, strengthening the role of precious metals as a stabilizing element within portfolios during periods of international tension. Beyond geopolitical and structural market factors, physical supply constraints have emerged as a key contributor to rising precious metals prices. Evidence of this strain can be seen in the depleted vaults of major trading hubs, including the London Bullion Market Association and the Shanghai Gold Exchange. These shortages highlight a tightening physical market that contrasts with the apparent liquidity suggested by financial trading volumes. When inventories in central vaulting locations decline, the ability of markets to meet delivery demands becomes more limited. This condition places upward pressure on prices, particularly in environments where demand remains steady or increases. The situation in both London and Shanghai indicates that available stocks of gold are being drawn down rather than replenished at the same pace. These supply issues are not the result of a single disruption, but reflect sustained demand interacting with constrained replenishment. As metal is accumulated by institutions and retained rather than circulated, less material remains available for active trading. This dynamic reduces flexibility within the system and heightens sensitivity to any additional demand shocks. The impact of depleted vaults is felt across regions. With fewer reserves accessible in major exchanges, the flow of metal between markets becomes more restricted. This further reinforces the disconnect between Eastern and Western pricing and complicates arbitrage mechanisms that would normally help balance supply and demand. Physical tightness, therefore, acts as a reinforcing factor in the current price environment. It ensures that increases in demand translate more directly into higher prices, supporting the sustained strength observed in gold and silver markets. The effects of these combined forces are clearly reflected in current price levels across the precious metals complex. Gold has reached an all-time high of $4,183 per ounce, marking a historic milestone in its valuation. This price level underscores the intensity of demand and the limited availability of physical supply in key markets. Silver has followed a similar trajectory, trading at $94.47 per ounce and approaching the $95 threshold. While not yet surpassing that level, its proximity highlights the strength of the rally and the supportive conditions surrounding the metal. Silver's performance is further emphasized by the gold-to-silver ratio, which has moved comfortably below the 50 mark, standing at 49.57. This ratio reflects a relative strengthening of silver compared to gold. Platinum and palladium have also recorded considerable gains during this period. Their upward movement indicates that the trend extends beyond gold and silver, affecting the broader group of precious metals. This collective rise suggests that market participants are responding to shared drivers rather than isolated metal-specific events. Together, these price developments confirm that the current environment is characterized by sustained momentum across multiple assets. The alignment of gold, silver, platinum, and palladium at elevated levels reinforces the view that structural and institutional factors are shaping the market, rather than short-term speculative impulses alone. Attention is also turned to upcoming regulatory changes in Asian markets, particularly the decision by the Shanghai Futures Exchange to reduce its position limits for silver futures by 57%. This adjustment represents a significant tightening of trading conditions and is expected to influence short-term price behavior, especially within Asian trading sessions. A reduction in position limits constrains the size of exposures that market participants can hold. In the immediate term, this may force some traders to unwind or reduce positions, potentially applying temporary downward pressure on silver prices in Asian markets. Such movements would not necessarily reflect a change in underlying demand, but rather an adjustment to new trading constraints. These changes may also alter where trading activity is concentrated. As participation becomes more restricted in Shanghai, liquidity and positioning could shift toward Western markets, where such limits are not being reduced in the same manner. This rebalancing has implications for price discovery, as activity migrates across regions with different market structures. The significance of this development lies not only in its short-term impact, but in how it reinforces the existing East-West divide. Regulatory adjustments in one region can now have disproportionate effects, given the reduced ability to smooth imbalances through global arbitrage. As a result, even if prices experience temporary softness in Asia, the broader market structure suggests continued strength elsewhere. Under these conditions, gold and silver may ultimately register stronger performance in Western markets as trading activity and demand reposition accordingly. Alongside market-driven forces, the behavior of central banks has become a defining element of the current gold environment. Institutions around the world are not only increasing their gold purchases, but are also choosing to retain existing reserves rather than liquidate them. This trend reflects a deliberate and coordinated shift in reserve management strategies. Central banks have been actively accumulating gold, with Serbia identified as one of the most recent participants in this movement. These actions are not isolated decisions, but part of a broader global pattern. Gold is being treated as a core reserve asset, valued for its universal recognition and its independence from political or monetary policy agendas. A central motivation behind this accumulation is a gradual erosion of confidence in the long-term credibility of the US dollar. While the dollar remains the dominant global currency, central banks are increasingly aware of its vulnerabilities. This reassessment does not imply immediate abandonment, but rather a diversification of reserves to reduce reliance on any single fiat currency. Gold's appeal in this context lies in its neutrality. It is widely accepted, globally liquid, and not issued by any government. For central banks operating in an environment marked by geopolitical tensions and financial uncertainty, these characteristics make gold an attractive and stabilizing asset. As a result, official sector demand has become a structural source of support for gold prices. Central banks are not acting as short-term traders, but as long-term holders, reinforcing tight supply conditions and contributing to the sustained strength observed in the market. The motivations behind central bank gold accumulation extend beyond short-term market considerations and are closely tied to changes in confidence in existing reserve assets. Although the US dollar continues to function as the world's primary reserve currency, its standing has gradually weakened. Erratic policy decisions, fragile public finances, and the increasing use of economic sanctions have contributed to a reassessment of its long-term reliability. This shift is visible in reserve composition data. Over the past decade, the dollar's share of total central bank reserves has declined from approximately 66% to about 57%. While this still represents a dominant position, the downward trend signals a clear change in institutional behavior. Central banks are not abandoning the dollar, but they are actively reducing their exposure. At the same time, no alternative fiat currency has emerged with sufficient global scale to replace it. The euro, pound, yen, and yuan each face structural limitations that prevent them from serving as a universal reserve substitute. In the absence of a viable fiat alternative, institutions have turned to gold as the primary counterbalance within their reserves. Gold's role is reinforced by its status as a universally recognized store of value. It carries no political alignment and is not dependent on the fiscal discipline or policy direction of any issuing authority. For central banks navigating an increasingly unstable global environment, this neutrality is a decisive advantage. This dynamic explains why gold has overtaken the euro to become the world's second most important reserve asset, ranking just behind the dollar. The shift reflects not speculation, but a structural realignment in how official institutions manage risk and preserve value over time. In parallel with increased accumulation, central banks are also changing where they store their gold. A growing number of institutions are choosing to repatriate bullion that had previously been held in foreign vaults. This movement reflects heightened concern over security, accessibility, and sovereign control in an uncertain global environment. Approximately 2/3 of central banks have indicated plans to relocate gold reserves back within their national borders. This trend has already materialized in several countries, including India, Hungary, Turkey, Poland, and Germany. In each case, the decision to repatriate reflects a preference for direct custody and immediate access to strategic reserves. These actions are particularly pronounced among nations exposed to geopolitical tensions. Countries facing higher levels of political or regional risk have emerged as leading buyers of gold. Over the past year, Global central bank gold purchases increased by around 10%, with significant contributions from Poland, Kazakhstan, Azerbaijan, and China. Despite these shifts, the United States remains the largest holder of gold reserves globally, with holdings exceeding 8,000 tons. This position underscores the continued importance of gold even among countries with established monetary dominance. Repatriation and accumulation together reduce the amount of gold circulating within international markets. By moving bullion into domestic vaults and treating it as a long-term strategic asset, central banks are reinforcing supply tightness and strengthening gold's role as a foundational reserve asset. Looking ahead, the trajectory of central bank behavior suggests that gold accumulation is likely to continue at a record pace into 2026. Institutions have signaled a clear intention not only to increase their holdings, but to retain them as long-term reserves. This approach reflects a strategic response to an environment characterized by geopolitical tension, financial uncertainty, and shifting confidence in traditional reserve currencies. Gold's position as a neutral and universally accepted asset places it at the center of this strategy. With no clear fiat alternative capable of matching the global reach of the dollar, central banks have increasingly relied on gold to diversify and stabilize their reserve portfolios. This reliance is reinforced by the decision of many institutions to repatriate their holdings, further emphasizing gold's role as a safeguard rather than a trading asset. These developments have broader implications for precious metals markets. Sustained official sector demand limits the availability of physical supply and reduces the likelihood of significant drawdowns driven by institutional selling. Combined with structural market divides, regulatory shifts, and ongoing geopolitical pressures, this dynamic provides a durable foundation for elevated price levels. The rise of gold and silver to record highs is therefore not the result of a single crisis or collapsing currency. It reflects a complex alignment of market structures, policy decisions, and institutional priorities. Within this framework, precious metals have reaffirmed their role as central components of the global financial system, shaped by long-term considerations rather than short-term disruption.